So my name is Brittany Leonard. I am a partner in the La Crosse office of Hawkins Ash CPAs. I am the leader of our firm's non-for-profit committee. And today, so our non-for-profit committee, we have about 10 individuals from our firm, ranging all the way from senior associates up to partners. And we really work to collaborate and meet throughout the year to kind of keep up on different continuing education, standard changes, and also to do great things like this, host some webinars to help people learn and kind of develop from some of our experiences. So what we put together for you today, we've got 3 presenters lined up to touch on a couple different topics specifically related to nonprofit. So the slide deck did get emailed out to all participants yesterday, but if you did not receive it for some reason, if you go to the chat, there is a PDF download available there. As we're going through, if you have any questions that you'd like to ask some of our expert panel or other members of our group, feel free to put it into the Q&A area. I'll be monitoring that throughout the presentation, and we'll kind of maybe work in some of the questions as we go as they apply to each of the different areas that we'll cover, and anything else we'll kind of take some time to answer at the end. So before I get started, a big thank you to our presenters, Rachel Burrow, Emily Donohue, and Bradley Knowles. They've spent a lot of time putting together these slides and putting together their presentations today. So thank you to those 3. And I'll get started with a little bit of an introduction on Hawkins Ash CPAs. So Anna, if you want to advance the slide. So we've got 10 offices throughout the state of Wisconsin, or the states of Wisconsin and Minnesota. There are approximately 27 partners, 63 CPAs on staff. Our net revenue is typically around 33 million. Our firm was founded in 1956. We have around 195 employees and over 10,000 clients. One of our specialty areas is not-for-profit organizations. We do a lot of auditing, 990 preparation, and other state reporting. So we've got an awesome team of people that kind of help us serve those clients. And then our locations in the state of Wisconsin are kind of here on this map. You can see we're spread out all over the state of Wisconsin. So most of our audit practices are led out of our Green Bay, La Crosse, Manitowoc, and Rochester offices. So I'm sure a lot of you that are on the call that are audit clients of ours, you've met people from those respective offices before. And then I'll just kind of go through a brief overview of what we're going to cover today. So we're going to start off talking about capital campaigns and unconditional promises to give. Then we will move on to discuss revenue recognition for grants and contributions. And we'll finish it off with a discussion on endowments. So the first presentation, we're going to cover capital campaigns and unconditional promises to give. So I'm going to hand it over to Mr. Bradley Knowles.
Hey, my name's Brad Knowles. I'm a senior associate. Been with the firm 6 years now, and do primarily auditing of nonprofits, as well as some other different types of entities. You want to go to the first slide there, Anna? So first, I just want to start off with a quick overview of some of the types of revenue a nonprofit could have. Emily's going to do a good job later of doing the revenue recognition in depth. So I just want to give some context to what we're talking about here with capital campaigns and pledges. So there are 2 broad categories or buckets that nonprofits would classify their revenue into. The first one is exchange transactions. So these are going to be your business-like activities like sales of products or services for a fee, and these are accounted for under ASC 606. And ASC stands for Accounting Standards Codification, and the number is the topic number. There are lots of different topics, and that's what makes up US GAAP, or Generally Accepted Accounting Principles of the United States. The other category is contributions. These are revenues that are a gift of cash or property made to a nonprofit to help it accomplish its mission, and your donor is not receiving anything of value in return. In other words, they're not buying anything from you. This type of revenue is accounted for under ASC 958, and this is where capital campaigns and pledges fall into, and that's where we'll dive into further. So within contribution revenue, there's sort of another two main types of contributions. So there are a lot of different ways that contributions can be structured. You can have restricted, unrestricted, conditional, unconditional, cash, property, grants, et cetera. But in general, there are two main types, and that would be donations and pledges or unconditional promises to give. Donations are pretty self-explanatory, and that's probably what you picture in your mind or you most associate when you hear the word contribution or donation. They're just a transfer right now of cash or property to a nonprofit. So if someone hands you cash or writes a check or gives you stock or other property, you debit your balance sheet for the asset that you received and credit the income statement for donation revenue. It's the most basic type of contribution, also the most intuitive, pretty easy to wrap your mind around. And then this can get more complex for donations of property or stock, but the important part to understand is this is a right now thing, as opposed to pledges or promises to give, which are transactions that will occur at a future date. And these can occur at any time, but are most frequently associated with a capital campaign. And this is where things get less intuitive, and we'll dive into that a little bit further. So sometimes a donor will say, hey, I'll give you money next year or the year after or later on. That could be a promise to give, or they might say, I'll give you money if you meet some sort of criteria or overcome some barrier. A simple example of this would be a matching donation. So the donor says, I'll give you $100,000 once you raise $100,000 from other sources. That could be a conditional promise to give. And conditional promises to give are beyond the scope of this presentation, but I just want to make you aware of what constitutes a donor condition and the ramifications of that, so I'll touch on it a little bit. For a donor condition to exist, two things must be true. One or more barriers must be overcome before you're entitled to the assets. A barrier can be internal or external, but a barrier cannot be a trivial stipulation or an administrative task or the simple passage of time. And then the second thing is that there's a right of return to the contributor for the assets transferred, or a right of release of obligations if it's a pledge or a promise. So if you don't overcome the barrier, you have to give the asset back, basically. If both of those things are true, then you have a donor imposed condition, and you wouldn't record revenue until the condition's met, and the donor doesn't record the donation or expense until the condition is met. And then on the other hand, if you have a promise to give that doesn't contain both of those things, it's an unconditional promise to give. And unconditional promises to give, again, can occur at any time, but are most often associated with a capital campaign. And I'll touch on this more in a bit, but an intention to give is not the same as a promise or a pledge. And with a promise to give or a pledge, the donee would record revenue and a receivable of the pledge, and as well as an allowance for non-collectible pledges and a time value discount. Next slide. So our pledge is legally enforceable. Most of the time, they are considered legally enforceable. Pledge drives and capital campaigns are a really important part of fundraising activities for nonprofits. And as we said, the nonprofit will record an asset at the time the pledge is made and the pledge receivable, and the directors and trustees of nonprofits generally have a fiduciary duty to protect nonprofit assets. Some reasons that the courts have found as a basis to legally enforce pledges include things like work on the project that the assets are pledged for has already begun. Pledges can be used as collateral for loans to nonprofits in the course of completing large projects. Maybe a large donor's pledge has induced other donors to also pledge or donate. And the nonprofit's acceptance of a pledge generally means that the nonprofit has agreed to designate funds according to the donor's wishes, or that the nonprofit has agreed to do something or not do something. And some states' law, such as Ohio, considers a pledge to be the same as a promissory note. So why would a nonprofit want to collect pledges instead of maybe just donations? Collecting pledges or running capital campaigns is a great way to collect a lot of money quickly for a big project. Pledging lets donors spread their gift out over time, making the gift more affordable for the donor, as well as increasing donor engagement. And donors may feel more connected with the project than if they simply made a one-time gift. If you're running a capital campaign, you'll be getting your message out to a larger pool of donors, and more media attention, and you might also retain some of those donors even after the campaign is done. And as I said before, you'll likely be able to use pledges to obtain financing for your project. On the other hand, the administration and accounting for pledges can be more complex and burdensome. So pledge tracking generally requires the use of specialized software, and collecting on pledges can require a lot of time and resources. You'll also need to send more donation receipts or acknowledgement letters, as you'll have an increased volume of donations during a capital campaign. And you also need to keep your donors up to date on the status of the project. And if you're running a capital campaign, this can come with a cost in both dollars and time. So what is a capital campaign? Capital campaign is a targeted fundraising effort to raise a specific amount of money that takes place over a defined period of time. So what does that mean? They're usually for specific purposes that would be outside of the normal operating budget, such as a large construction project, purchase of equipment or land, or new major programs or initiatives, or sometimes for endowment funding. The money that you collect should be over and above normal operating contributions, which should make sense because we said that capital campaigns are generally for items that fall outside of the regular budget, and a properly run capital campaign should not cannibalize your regular donations. And they're a good way to raise a large amount of money quickly. And on the flip side of that, this isn't something that a nonprofit is going to be doing all the time necessarily. Depending on your organization, you may only do a capital campaign once every 10 or 15 years. And because this is an all hands on deck endeavor, which probably needs board approval and support, an organization that's ready to run a successful capital campaign probably has some dedicated development staff or a development director, as well as some really good people in the accounting department, and everybody needs to work together to run a successful campaign. Capital campaigns require a lot of planning, and everyone working on the campaign needs to be involved from early stages for things to go smoothly. And capital campaigns are generally done in 5 phases. So we'll go over that now. So these are the 5 general phases of a capital campaign. You have the planning phase, which is probably the most critical phase. And then you have a quiet phase where you focus on building relationships with major donors. And then you have the kickoff phase where you actually announce the project to the general public, maybe do a press release, unveil architectural drawings, or what have you. And then during the public phase, that's where you close the gap and finish raising the rest of your goal through a public campaign and a wider variety of donors. And then the final phase is the completion or stewardship phase, where you thank and acknowledge your donors, collect on the outstanding pledges, and celebrate your project. So now I'm going to dive in a little deeper to some of these phases and some of the best practices to consider. So the planning phase is probably the most critical and potentially one of the most labor-intensive and longer phases of the campaign. On the very quick end, this could take 6 months out to possibly as long as 2 years. Pre-planning. Next slide. Pre-planning means that you first have to have a vision for something that your organization needs that will help you carry out your organization's mission, something that you don't currently have the resources for. And this vision is important because it helps you build your case for support. You need a compelling case for support before you approach donors, which also means you need a plan for how much money you need to raise and preliminary plans for the project. So one thing that probably also gets overlooked is drafting a gift acceptance policy. So now rejecting a potential gift may seem counterintuitive, but there are a lot of considerations when accepting a gift as a nonprofit. And this is a policy that every nonprofit should have, regardless of whether or not you have a capital campaign going on. But during a capital campaign, you're going to have an increased volume and complexity of contributions, so it's especially important. You may be receiving more non-cash gifts such as stock, property, equipment, or services. You'll be receiving much larger gifts and with more complex and creative structures probably than you've seen in the past. And that all has legal and tax implications for both you and the donor. And these gifts might come with conditions or naming rights, or in rare cases, depending on the source and amount, it could affect your public support test on your 990 and put your nonprofit status in jeopardy. So having a gift acceptance policy helps to vet gifts and helps donors manage expectations and protects you and the donor. Another consideration is creating a time tracking policy. So capital campaigns require a significant investment of hours from your staff, and some employees whose pay is normally allocated to management or program may shift to work related to the capital campaign. So this reallocation of labor should be reflected in your functional expense allocation. And also some labor costs related to construction of assets might need to be capitalized under GAAP. And another thing that definitely gets overlooked in planning a capital campaign is getting your finance and accounting people involved early. So most often accounting for a capital campaign is an afterthought, and the accounting department isn't brought in until after gifts are already being collected. Considering the accounting and tax implications of a capital campaign from the start will save time and expense and may avert potential problems later on. Some of the financial questions that you should ask in the planning stages of a capital campaign are things like, how long will the campaign last, and what is the projected cash flow needs before, during, and after assets are purchased? What types of funding are needed, and how are you going to solicit that from a donor? Are you going to need bridge financing or other long-term debt? What types of in-kind contributions are you going to solicit from donors? Are any donors likely to give through donor-advised funds or private foundations? Will the organization recognize any donors through naming rights or other substantial benefits? Will any existing assets be disposed of? And will there be staff dedicated to managing the campaign? And we all know that accountants speak a little bit of a different language, especially different from the people in development. And there's going to be a difference between what's counted towards the funding goal by development and what's accounted for reflected on the financial statements under US GAAP. So it's very important to get the accounting team involved in the process at the earliest opportunity. Next slide. So during the planning phase, you're also going to conduct a feasibility study, and this is where you test your preliminary plan. Some nonprofits choose to hire consultants to conduct a feasibility study and issue recommendations about the campaign. And while this isn't totally necessary, most of the consultants will help provide some of the other elements needed and guide you through the campaign. Part of the feasibility study is meeting with some of the potential large donors and interviewing them about their willingness to support the project and their ability to give, as well as gauging how the community will feel about your project. You'll also need to evaluate the resources that you currently have available, such as your current funds, equipment, staff availability, and volunteer availability. And then to wrap up the planning phase, you will reevaluate your goals based on the discussions you've had with your largest donors, and finalize the project's budget and the cost of the campaign. And so depending on the amount of money that you're raising and whether or not you hire a consultant, the campaign could cost somewhere between 5 to 15% of your total goal. And so this is also when you'll want to finalize any branding, mission statements, logos, brochures, pledge cards. And so if you do hire a consultant, they'll often have a team to help you with marketing and creating that stuff, and also sometimes provide you with software. And whether or not you hire a consultant, it's critical to know how you're going to track pledges and collections. And this goes back to why having the accounting staff involved from the beginning is very important. And so as accountants, oftentimes we need additional or different information than the development team. And one of the most frustrating things that we encounter as auditors is when a client is unable to create reports or provide information that we need to perform the audit. And it's likely that if your auditor needs to create data from scratch, you'll incur additional fees due to difficulty and time involved. So having a good system to track your pledges and payments will keep you organized and allow you to collect on pledges efficiently and effectively, and also save time and money during the audit, which means that more dollars can go towards carrying out your mission. So the next three phases are all about the fundraising. So this is where all the work in the planning phase hopefully pays off, and you can meet your fundraising goals. So first is the quiet phase, which is kind of a misnomer because it isn't that quiet, but it basically just means that you aren't soliciting donations to the general public yet. And this is where you have more private conversations with large donors and try to secure as many of the largest gifts that you can. And you should raise between 50 to 70% of your goal during the quiet phase. And the amount of money that you raise during the quiet phase will help determine how much your campaign can raise in total. So toward the end of the quiet phase, you revisit your overall goal and you might raise it or lower it depending on how well you've done during the quiet phase. And then the kickoff phase is when you'll actually announce your goal to the public. So you can have a press release or maybe a kickoff event or unveil plans or blueprints. And this is also an opportunity to recognize your large supporters that have pledged so far and have helped you get to this point, as well as any staff or volunteers that have been working for maybe a year or more at this point on the campaign. And this phase helps build credibility, urgency, and excitement, which will help secure the rest of your goal during the public phase, as well as potentially attract additional volunteers for your project or your organization. And then the public phase, which is relatively shorter at very high energy. And during this phase, you're targeting a wider pool of small donors to close the gap to your campaign goal. And the overall goal of this phase is to increase public engagement and excitement for your project and your organization. And this can include holding more events, updating donors on the status of the project, social media campaigns, highlighting what your project means to your organization and your community. And at the end of this phase, you hopefully will have met or exceeded your fundraising goals. So you're spending months and months collecting donations and pledges, and then I show up for the audit and I start asking questions. So now let's go over some best practices for pledge solicitation and tracking. So one thing to be aware of is that the language used on pledge forms and donor solicitation materials matters. And as we said earlier, intention is not the same as a promise. So there must be clear evidence of donor commitment in order to record revenue under US GAAP. And since maximizing donor commitments and recordable revenue is advantageous to most campaigns, you should use clear language that creates a binding pledge. So some language that would create a binding pledge might include things like I promise, I commit, I pledge and agree to pay. Some language that might only establish intent would be I intend to give, subject to availability, I will endeavor to give, this statement may be revised or canceled, or this is not a binding pledge. So consistently using language across all your campaign materials that establishes commitment rather than intent avoids ambiguity when it comes time to account for pledges, and also ensures uniform treatment of all your pledges for US GAAP. And it's also important to ensure that the amount of the gift and the timing are clear, because it can make recording the pledges and calculating future cash flows very difficult if there's ambiguity in the amount of the gift or the timing of the payments. And if pledge cards are confusing or poorly worded, it not only creates an accounting nightmare, but it can also cause conflict with your donors when you're attempting to collect pledges. And if your campaign involves physical pledge cards, which it most likely will, it's important to retain those to support your pledge balance and the amount of revenue you record, and also have them available for your auditor to review. And in addition to the physical pledge cards, you should have some way to track pledges electronically. Now, for smaller campaigns, you might be able to get away with something simple like a spreadsheet, but for most situations, you're going to have some type of software that can track aging and produce reports. So some things to keep in mind related to that. You want to be sure that whatever software you're using has the ability to run reports that includes dates. And I've seen some softwares for various things that for some reason can only run a report as of the day that you run it. So if you need a report as of December 31st, you physically have to run the report on December 31st. And if you don't, it's not possible to go back and get the report. And this makes accounting and financial reporting more difficult, both to your board and for the audit, and for internal tracking and pledge collection. So you want to make sure that you're tracking pledges and collections for each donor and be able to run reports that you can easily see an individual donor's outstanding pledges and their payments on pledges, especially to be able to give donors receipts and acknowledgement letters when they fulfill the pledges. And then you also want to make sure that you can differentiate pledge payments from one-time donations, both in your tracking software and for accounting purposes. So you should make separate GL accounts for your campaign revenues and collections as well. Which leads us into everyone's favorite part, the accounting. So the first thing to keep in mind is not to net together capital campaign revenue and expenses. And this seems tempting to do because it seems like maybe you're keeping things segregated or you're keeping track of campaign funds, but it's not appropriate treatment for GAAP. So a better way to do this is to set up separate expense accounts for project expenses, or in QuickBooks, use something like classes or tags. And pledges also have to be recorded at fair value under GAAP, which means that you have to record an allowance for uncollectible pledges as well as a net present value discount. And so I'll go through an example of that. So let's start with a hypothetical pledge of $100. So no cash has been donated yet, but you've gone out and solicited a donor and they've made a binding promise to give of $100, and they want to give that $100 over the next 5 years in 5 equal installments. So at the end of December 2023, you've got an outstanding pledge of $100. So now, like we've said previously, pledges are considered legally enforceable, and under GAAP, you record the revenue at the time the pledge is made. So for December 2023, you would record a $100 credit to a contribution revenue account, and your debit is to your balance sheet for the pledge receivable of $100. So you'll likely have to create a new asset account for this if you never had pledges before. So now you have an asset on your balance sheet of $100 pledge receivable, but now you have to adjust that to fair value. So first you have to do a net present value calculation, which accounts for the time value of money. And I think we can probably all agree that a dollar today doesn't go as far as it did even 5 years ago. So basically, we're trying to account for that in our pledge balance, and that $20 that we're going to collect in 2028 isn't the same as $20 today. So to do the calculation, we need a rate. And typically we can use what's known as a risk-free rate, which would be like a US Treasury rate. And you'd want to use one rate for your entire campaign at the end of the year, and you can kind of go based off your longest pledges. So since this is a 5-year pledge, we would use a 5-year Treasury bill rate. In the example, I just went with 3% to keep things simple. And then you can use a net present value function in Excel or some other time value of money calculator to do the calculation. So in this example, we have a net present value of $91.59. So a net present value discount of $8.41. So the best thing to do is create a contra account, or in QuickBooks, like a sub account, and then record the discount separately, because you'll have to show the total amount pledged and then the discount separately in your financial statements. And then the other piece you'll need to record is the allowance for uncollectible pledges, because even though pledges are legally enforceable and you're going to make every effort to collect on them, things do happen and you're not going to litigate every single pledge. So there will be uncollectible pledges. So you need to come up with an estimate of what you think will be uncollectible, and you should have some sort of basis for that. It's not just a guess. So you can consider past experiences. If you've had capital campaigns in the past, you can consider the economy, unemployment rate, or even what you know about individual donors themselves. But you need to make some sort of an estimate of uncollectible pledges and then record that allowance to your balance sheet to reduce the amount of pledges receivable shown and then to your income statement as bad debt expense. So for this example of $100 pledge, I estimate $5 won't be collectible. So after adjusting for the net present value discount and the $5 allowance, the net amount on the balance sheet as of December 31st would be $86.59. So a couple other things to keep in mind on the accounting is capital campaign revenue will generally be considered donor restricted and included in restricted net assets. So pledges that have not been collected yet will be considered time restricted. And once they are collected, they'll be considered purpose restricted. And if your capital campaign is for a construction project, even though you have expenses throughout the year, you can't release donor restricted net assets until the asset is actually finished and placed into service. And donations of stock or other properties such as equipment or land are also valued at fair value. So generally for something like land, you'll probably need to get an appraisal done for that. And donations should be recorded as revenue when they're received or at the time they're pledged, not based on the check date. And this is especially important to keep in mind near the end of the year for proper cutoff. And then just a couple key takeaways. Once your organization decides that you're going to have a capital campaign, ensure that the accounting team and development team are working together from the start and have good documentation for all your pledges, as well as a good system to track pledges made and payments on pledges, and have a good system to track capital campaign revenue and expenses. And don't forget that you might need to allocate some of your regular expenses to marketing or development. And use consistent and clear language across campaign materials to make sure you're creating legally enforceable pledges, as well as establishing the use and purpose of the funds. And know your accounting of the funds and related costs, which is what Emily is going to talk about now.
Good morning. My name is Emily Donohue. I am an audit manager in our Green Bay office. I work mainly on voucher school audits, not-for-profits, and employee benefit plan audits. I'm going to talk about revenue recognition for grants and contributions. I have a few things that are repetitive of what Brad had talked about, so we'll just talk about those again, and then some new information as well. So the FASB or Federal Accounting Standards Board definition of a contribution is an unconditional transfer of cash or other assets, as well as unconditional promises to give to an organization, or it could also be a reduction, settlement, or cancellation of its liabilities in a voluntary non-reciprocal transfer by another entity acting other than as an owner. Brad talked about this, but simplified, it's a donation. It can be cash, non-cash assets, services, promises to give financial resources or non-cash assets at a future date, or cancellation of liabilities, which would be something like forgiveness of debt. Next slide. So Brad touched on a lot of this, but again, promises to give are an agreement to contribute cash or other assets to an organization at a later date. The recipient of a promise to give has a right to expect the promised assets will be received in the future based on the agreement, and the donor has an obligation to make the promise transfer or to pay the amount that was promised. As Brad mentioned, these can be conditional or unconditional. And I'll go into a little bit more detail on the difference between these. So unconditional promise to give have no barriers that the recipient must overcome to receive the contribution. Fulfillment depends only on the passage of time or demand by the donor for performance. An example like Brad talked about would be if a donor says that they're going to pay $100,000 in 5 installments through 2028. A conditional promise to give has barriers or conditions that the recipient must overcome in order to receive the donation. And failure to overcome the barrier gives the donor the right to a return of the assets. So if the condition is not met, the donor can ask for the funds back if they've already paid them, or they would not be obligated to pay them in the first place. It's important to note that conditions are not administrative in nature. So if you receive a donation and it states that program statistics need to be provided to the donor, this is considered an administrative function and it is not actually a condition or a barrier to receive a pledge. Therefore, it would be considered unconditional. A key indicator as to whether a promise to give is conditional. Oh, sorry. Yeah, I just have notes here, Anna. A key indicator as to whether a promise to give is conditional is the existence of a measurable performance-related condition, and they include the occurrence of a specific outcome or event, or achieving a certain level of service or output of goods. So some examples of conditions might be serving 25 students in a certain program by 2025. It's measurable and it's specific, so it's considered a condition. As Brad mentioned, matching funds are an example of a condition. So if a donor says that they'll donate $50,000 based on the organization also receiving $50,000 from other donors, that's conditional. Completion of a project is also an example of a condition. Next slide. So 2 examples to kind of help differentiate between conditional and unconditional. Charity A runs a feeding program in an area with a large population of homeless people. The charity receives a contribution to assist with the feeding program, which requires the charity to provide 1,500 evening meals per month. The barrier here is to provide the specific number of meals at a particular time of day. So this is a measurable performance metric, and this would be a condition. Charity B operates an educational outreach program. The charity receives a contribution that indicates the goal is to fund 5 part-time staff and purchase equipment the staff will need in their outreach. The contribution is silent on whether funds must be returned if those staffing levels are not met. So the staffing level is merely a goal. It's not a barrier to overcome, and there's no right of return on the donation. So this would be considered an unconditional contribution. So Brad touched on the elements of a promise to give. It must be legally enforceable, which he went into detail on, and there has to be documentation of it. It's just 2 things I want to note here. So documentation can be written or oral. Written documentation examples could be a signed pledge card, donor letters, or other written correspondence from the donor. Oral promise could be a recording of a telephone or other conversation, or a written log of promises made orally that can be verified with the donor. We recommend obtaining written documentation for all pledges as often as possible. So when to recognize contribution revenue? Generally, contributions are recognized when received. On regular donation, one-time donations and unconditional promises to give are recognized in the period when received or when the promise is made, not when the actual transfer of resources occurs. So for pledges, you report a receivable on the balance sheet and then contribution income on the income statement. Conditional promises to give are recognized as revenue when the barrier or condition is overcome. So that one example where they serve 1,500 meals, that would be recognized as revenue when those 1,500 meals have been served. They've met that condition, and so then it's revenue to the organization. Unconditional promises to give and donations, contributions can be received with donor restrictions and should be reported and tracked as such. Unconditional promises to give are tracked in net assets with donor restrictions. They are always tracked with time restrictions, as an organization agrees to future payment dates when they accept a pledge, donors are implicitly indicating the gift is to support activities of the period in which payment is scheduled. And those time restrictions are released to net assets without donor restrictions in the period when the payment is received. They can also be unconditional promises to give, and donations can also be received with purpose restrictions. And these would be restrictions that the donor specifies a specific use for those funds. It's important to note that contributions can only be restricted by donors. Funds restricted by board members and management of the organization are considered board designated. These funds are reported in net assets without donor restrictions on the statement of activities and the statement of financial position. Types of donor restrictions. There's time restrictions, as I mentioned, with promises to give. So these are donations that are given and restricted for a period of time. As we mentioned, promises to give. So if payments are due for the next 5 years, those are restricted for that time period. And then time restrictions are released when the receivable is received. There's purpose restrictions. This is when the donor gives funds and says what they would like the funds to be used for. An example would be used for a specific program or project, such as maybe a reading program at the organization. And these restrictions are released when the funds are spent for that donor specified purpose. It's important to note that when donations are received with donor restrictions are different than conditions. So these are recognized as revenue when they're received and not when the condition is met. And then there's permanent donor restrictions. This is if the donor state's resources or the funds must be held by the organization in perpetuity. The restriction is never released unless the organization receives approval from the donor to use those funds for a different purpose. An example of this is if a donor contributes $100,000 and states that they want the organization to invest the money in an endowment to provide a permanent source of income for scholarships. In this case, you would recognize the $100,000 as revenue when it's received. You'd put it into your investment. The $100,000 would be reported as permanently restricted net assets with donor restrictions. And the income on the endowment would be purpose restricted for scholarships. If the organization gave $100,000 and they said that the income, the $100,000 is permanently restricted, but the income on it is to be used to support the organization, the $100,000 would be considered permanently restricted, and the income on the $100,000 would be reported as without donor restrictions. Next is tracking donor restrictions. So it's important to, when you receive contributions with donor restrictions, it's important to ensure that donor wishes are being met and those funds are being used for what they've specified. As Brad mentioned, some ways to track restrictions and related spending would be to create classes or projects in the accounting software. You would record, if you use a class in QuickBooks, you would record the revenue and related expense in that class. You could also use an Excel spreadsheet where you would put like a beginning balance, any contributions during the year, related expenses, and then you would calculate an ending balance. It's also important to retain documentation as evidence of donor restrictions and fulfilling those restrictions. Examples of this evidence might be donor communication and check stubs, so those pledge cards, donor letters, any other written communication, copies of check stubs if they state those restrictions, and then any expenses and support for expenses and fixed asset purchases, such as invoices and check stubs for payments made. Organizations might also receive stock donations. So if you receive a stock donation, the stock becomes an asset of the organization once it is transferred to the organization, not when it is sold by the organization. It should be recorded as an asset on the statement of financial position and then contribution revenue on the statement of activities at the time it's received at the fair value. And a lot of organizations have a policy that if they receive a stock donation, that it should be sold right away. So if that is the case, you still record the original contribution as contribution revenue, and then any difference between the proceeds received from the sale of the stock and the fair value recorded on the date received is recorded as a realized gain or loss on the statement of activities. It's also important to note that a donor can use a stock donation to pay a pledge and reduce their pledge receivable balance by the fair value of stock on the date received. And in this, if that's the case, you would decrease the pledge balance and record the asset on the statement of financial position for the fair value of the stock on the date it was received. If the fair value of the stock upon receipt is greater than a pledge receivable balance, you record a additional contribution revenue for the difference. Organizations can also receive contributions of non-financial assets. One type of that is a contributed service. So these would be in-kind services received by your organization. Contributions of services are recognized if the services received meet either of the following criteria. They must create or enhance non-financial assets. And they require, if they're services, they require specialized skills, are provided by individuals possessing those skills, and they would typically need to be purchased if not provided by donation. These contributed services are recognized as revenue when they are received. And some common examples would be accounting services, legal or attorney consultation services, and construction services. If any of those types of professionals provide services to your organization at no cost or at a discounted cost, you record that as a in-kind contribution revenue and a related in-kind expense on your statement of activities. Your organization might also receive contributed non-financial assets. So a couple examples of this, items contributed for use in fundraising, such as auction items. And these might be things like tickets, gift certificates, works of art, or merchandise that are given away or sold as auction items. If you receive these items, you record an inventory asset at fair value for the items when the items are received. And then when they're sold, so you would debit an inventory asset and credit contribution revenue, in-kind contribution revenue. And then when they're sold at the auction, you record the difference between the amount received for those items and the fair value originally recorded as an adjustment to the original contribution amount when sold. So if the original amount received was $50, you would debit your inventory asset for $50, credit in-kind contribution revenue for $50. Say it sold for $60, you would debit your cash for $60 and credit your contribution revenue for an additional $10, and credit the inventory asset for $60 to take it off, or $50 to take it off the books. Items contributed for use by the organization. So this might be maybe a copy machine was donated and you're using it in program services. These are recorded as revenue at fair value when they're received. Grant revenue. This refers to government grant revenue. It can be from international, national, local, or quasi-governmental agencies. Government grants do not include amounts received in transactions with the government that are part of the normal business transactions of the entity, tax credit or other tax incentives received, or government involvement in the ownership of the entity. grants from private foundations, corporations, individuals, etc., should be recorded as contribution revenue. So grant revenue should only be considered grant revenue if it's received from governmental agencies. To record grant revenue, you distinguish between grants that are exchange transactions and grants that are not exchange transactions. So as Brad mentioned, exchange is a reciprocal transfer between two parties that results in one of the entities acquiring assets or services or satisfying liabilities by surrendering other assets or services by incurring obligations. Basically, a payment for service. An example of an exchange grants at an exchange transaction is payments from Medicare, Medicaid, or another state agency where the agency is covering the cost of care to a specific individual. So the organization would be providing that service to the individual, and they're receiving payment from the government for those services that are provided. Revenue for this is recorded when earned in accordance with ASC 606. Refundable advances. So if you receive grant revenue that you receive the funds and they're to be used for specific services or a specific purpose, and if those purposes or services are not offered, or the grant funds are not fully spent for those purposes, the funds may be required to be paid back to the government agency. Funds would need to be returned if the conditions are not met. The funds should be accounted for as a refundable advance until those conditions have been substantially met. So a refundable advance is a liability on the statement of financial position. When you receive this, you debit cash, credit the refundable advance as a liability. And then as you use those funds for the specified purpose, you would debit or reduce the liability and then credit or recognize the revenue on the statement of activity. A common example that most organizations experience in the past couple of years of this is the PPP loans. So you received funds based on an application and your expected payroll costs for a future period. You received those funds in advance, and then you had to provide support or prove that you incurred those expenses for a certain period. So when you received those funds, technically that was considered a refundable advance as a liability. If you didn't spend all of that, those funds would be required to be paid back to the government. And then if you had spent all those funds and your forgiveness application was approved, then that refundable advance was moved to the statement of activities and recorded as revenue once that application for forgiveness was approved and the related expenses were incurred. The other type of grant is grants that are not exchange transactions or grants that are contributions. For these, you determine there's no reciprocal exchange and you record the revenue the same as a contribution. So it's recorded when it's received. And then there's reimbursement grants. So this is a grant where funds are received only after eligible expenses are incurred. And typically the organization has to submit a reimbursement request. So they prove that they've incurred those expenses and they request reimbursement for those expenses. The revenue for these types of grants is recorded when the expenses are incurred and the reimbursement request has been submitted. There's typically, if these fall over year end, you may have a grant receivable on the books to cover that period so that the grant revenue matches up with the expenses in the period that they were both incurred. Two examples of grants to differentiate between the exchange and non-exchange transaction. So a student is enrolled at a university tuition is charged to the student for $20,000, but the student receives a $5,000 state grant that is paid directly to the university and applied to the student's receivable balance. So this is a grant that is an exchange transaction because the grant benefits the student and the university is receiving payment for providing education to the student. So in this case, the revenue is recognized when it's earned. A homeless shelter receives a grant from the county to provide shelter for a night to individuals who meet criteria designated by the organization and the county. This grant benefits a group of beneficiaries and therefore is a non-exchange transaction, and it's recognized when it's received. So the difference here is that the homeless individuals staying, or the organization isn't receiving any payment for services being provided to specific individuals staying at the organization or the homeless shelter. It's simply providing a benefit and receiving funds to support those individuals. So it's not an exchange transaction and it's recognized when received. That's all I have.
All right, before we get started with Rachel's section on endowments, I'm going to go through a couple of these questions. So Emily, do you mind if I direct a couple questions at you?
Sure.
All right. So for the auction items, what if they are all artwork and we aren't told a value when donated by the artist?
So I would either reach back out to the donor to see if they can provide a fair value, or do some research to try to determine a reasonable fair value. Do you have anything to add to that, Brittany?
Yeah, the other thing I would say too is, I mean, if you're dealing with some fairly expensive pieces of artwork that maybe the valuation is a little bit more complex, we would always recommend an appraisal in those circumstances too. Probably not just your everyday $100 to $200 value piece of artwork, but if you do have some that are of larger value, we would recommend that appraisal. Okay, and then one other question for you, Emily. Is there a stipulation to spend restricted money first? And I can help you with this if you want me to also.
Yes, so I would say that it's always beneficial to show that you're spending your restricted funds, and you would show that those funds are spent before unrestricted funds. If a donor is giving you money for a specific purpose, they want to see that those funds are being spent for that specific purpose. And if they see that they're not, they might be concerned or might choose to not donate in the future.
And one other thing to be careful of too is some of the stipulations that come with it too is they tag certain years to the contributions that you're getting. So you do want to make sure that you're following any of those types of restrictions that your donors are stating too. Okay, Brad, I got a couple questions. We'll kind of loop back into capital campaigns. So the first one, this is an excellent question. So is the NPV discount and allowance for uncollectible pledges required if the pledges are expected to be collected within 12 months or less, and then not necessarily within the fiscal year though?
I would say no, they're not. You don't calculate a discount if it's 12 months or less. So it would just be everything over 12 months.
Yeah. And I agree. I would consider an allowance for uncollectible pledges. You should definitely do that. Although I'd say it's probably a little more unlikely given the short time period. That should always be considered. But again, like Brett said, that NPV discount, you would not calculate it if it's expected to be collected within 12 months. And then one other question, and I can take this one, Brad. Would the consultant normally assist with setting up the accounting? So this is in regards to capital campaigns, if you're utilizing a consultant to do your capital campaign. So what assist with setting up the accounting process? It seems like a specialty type of accounting that a bookkeeper may not have the skills for. I would say the answer is going to depend. It depends on the software provider that you're using. I know Some of them do have those capabilities where they will set you up with the entries, and they'll kind of help you with that accounting process. But in my experience, I can't say that every single one does that. It's certainly something that you could try and ask for. A lot of times the consultants are more geared towards helping you set up a great capital campaign, help you get the advertising out there. So not all of them may have the knowledge of the accounting processes. One thing I would encourage is try to reach out to your CPA that you work with if you do have questions on it, because they can certainly help set up those entries and get you in a process where some of that stuff is, or where everything's being reported properly. So that takes care of a few questions right now. Oh, one follow-up on the NPV discount and allowance for uncollectible pledges, asking about a dollar threshold. I would say yes, there is kind of a dollar threshold on that. I mean, if you're getting to the point where your discount is less than $500, I would say it's probably not necessary to record. Ultimately, if you are an entity that is having to have an audit done, every client's materiality is a little bit different. So some people's dollar thresholds may be $100, some of them may be $3,000. So I will say that answer is going to depend. I can't give you necessarily a cut and dry there. All right, so that's all the questions we've gotten so far. So let's move on to endowments. And feel free if you've got follow-up on any of the ones I answered, or you have other questions you want to ask. We've got some time pegged at the end to go through more questions too. So keep those things going in the Q&A or in the chat. I'll turn it to you, Rachel.
Okay, so now we're going to move into endowments. I'm Rachel Burrow. I am a senior manager here in La Crosse, and I've been with the firm for 5 years. I do nonprofit audits, benefit plan audits, commercial audits. So I do a wide range, but today I'll focus in on endowments. So I thought we'd start by just a basic definition of an endowment. So I'm just going to read this right off the slide here. A donation of money or property to a nonprofit organization which uses the resulting investment income for a specific purpose. So we kind of referenced these in Emily and Brad's presentations as well. It's a way for a nonprofit organization to kind of have a set-aside fund that each year earns money that they can use for either a specific purpose or in some cases just operations. Most of these are designed to keep the principal amount intact while using the investment income for charitable activities, kind of like I just said. And endowments can be either with donor imposed restrictions or without, and I'll kind of go through a couple of those instances in my presentation here. In most cases, endowments are established by donor restricted gifts and bequests. So, you know, typically those are the two main ways endowments are set up. Go ahead, Anna. Okay, policies. We like to talk about policies here. So a couple different policies that we recommend you have in place before you're accepting endowment gifts. As investment policy is one. Most nonprofits rely on a professional investment advisor to do the actual investing of funds, and you know can be a complex thing to know how to invest your money wisely. So it's good to have an investment policy in place and have a couple things in writing. The policy should include what types of investments the manager is allowed to make. Depending on your organization, there are certain investments you might want them to stay away from, or types of investments. And this is just a good way, again, to have it in writing so it's clear. Another thing would be how aggressive the manager can be. So some policies are as specific as saying we want 75% to be in fixed income funds and 25% in equity funds. It can kind of be tailored to your organization, and this policy should be approved by the board, management, just so everybody's on the same page. Another policy that should be in place before you have your endowment gifts being accepted would be a withdrawal or spending policy. And this policy establishes the amount the organization can take out each period. It can be based on the needs of the organization. Also, most endowments come with some sort of agreement, written agreement, and these endowments can use a percentage of the total amount of the fund in a lot of cases. So, an endowment might say you can spend up to 5% of the market value each year would be an example. And then the withdrawal or spending policy can also include the amount of principal that needs to be maintained in the account. So this would be more for an example of where an organization sets up an endowment internally. So they have rules in place for these funds and how much should be maintained and what can be spent. Okay, so we'll go into donor restricted endowments. This is a source of income for nonprofit organizations in perpetuity or for a specific period of time. So basically what that means is whatever the donated funds are, so if it's a $100,000 gift, that amount needs to remain in this investment account until, if at some case the donor would give permission to spend that amount, or if it would be an endowment that's set up for a specific project once the project is complete. The amount of the original gift stays in the investment account, like I said, and then earnings each year can be used by the organization as long as it's in line with the intended purpose. So that's really important just to remember, if the endowment is set up by a donor for a specific purpose, those earnings need to be spent on that purpose when they're spent. Okay, so then most of these would fall under the Uniform Prudent Management of Institutional Funds Act of 2006, called, I always say UPMIFA, a little bit more fun to say than the Uniform Prudent Management of Institutional Funds Act. So what UPMIFA says is donor imposed restrictions are extended to the investment return until funds are approved to be spent, kind of like what I just said on the previous slide. And also something to consider is any subsequent gifts to the fund. So let's say, for example, the original donor of the endowment in 10 years decides, I want to add some more funds to this endowment, and they give another $25,000, that amount would also be held in perpetuity and with those donor imposed restrictions. Approval of expenditures for the endowments, it can be done a couple different ways. It can be done during the organization's annual budgeting process. So if there's an amount that the organization wants to plan to spend for the year, the approval can occur at that time and then just kind of carries over throughout the year. Or if you want to do it as needs arise, it'd be a good idea to have it in your board minutes at a monthly meeting, or as often as you do meet, just making sure it's documented that approval of the release of those funds is documented. And then the reported in net assets with donor restrictions until they're spent, those donor restricted endowments. Okay, so just a general example, a donor leaves $300,000 to be used to provide scholarships for students attending a particular school district. So the purpose is scholarships for those students. The fund agreement specifies that 5% of the market value can be distributed annually for scholarships. So, during the year, those funds can be awarded as long as it's staying in that threshold that's set by the agreement. And then the fund agreement also notes that all funds contributed will be kept in this separate account. So if you go to the next slide. So I just thought we'd kind of cover how this would impact your financial statements. So Emily kind of covered some of this in her presentation as well, but an investment account would be included on the balance sheet or the statement of financial position at fair market value at year end. There would also be a donor restricted contribution of the $300,000 recorded in the year it was received, and that would be your revenue. Net assets with donor restrictions for the $300,000 plus the market earnings for the year that are not spent would be recorded. So you have to keep that in mind. Let's say if the market made $20,000 for those funds and 10,000 were awarded in that same year for those scholarships, only 10,000, the remaining 10,000 would need to be included with that donor restricted grouping. And then at this point, the $300,000 would be the amount maintained in perpetuity. Net assets are released to net assets without donor restrictions in the year the earnings are spent on scholarships. So that would really apply in that example I just gave. Let's say that $10,000 you kind of carried over to the next year. That would be released then. It would show on your releases on your financial statements if you spent it in the next year on scholarships. You can go ahead. Okay. Board designated endowments. So this is a little bit different than a donor restricted. An endowment fund created by the organization's governing board with net assets without donor restrictions. I'm just going to take a. Okay, so this is the organization deciding we want to put aside some money for whatever purpose they, it could even be general operations, but these are sometimes called a quasi-endowment. They are not donor restricted, so it's a little bit different. Both the amount of the original endowment and the earnings on the funds are without donor restrictions, and they can be used for any of the organization's operations or programs. If the board approves these for a specific purpose, though, they're still considered net assets without donor restrictions. It's just, maybe they're tracked separately and set aside for whatever purpose the board decides. The nice thing about that is, if something changes in the operations of the organization over time, since it's not donor restricted, with a board approval, you could change what those funds would be used for. Okay, so here's a little example. XYZ organization has built up an investment portfolio of 25 million. Good for them, right? The organization decides then to set aside some funds in perpetuity for future operating needs. So the board votes to approve the transfer of $2 million to an endowment fund for this purpose. So the $2 million plus any earnings on those made on those investments are included in investments as an endowment at year end. The fair market value of these funds are included in net assets without donor restrictions. And also just to note, board designated endowments are a separate line in the endowment disclosure. And I actually provided an example later on. I can kind of show you how that looks, but they are tracked separately, and it's important to keep them tracked separately since those donor restricted funds are shown different in your financial statements. And then each year, the earnings on this endowment can be used for the operations of the organization. And it's kind of a good way, without using savings or cash, to have funds continually coming in for the organization and the mission. And I thought we could cover just one slide here on underwater endowments. A couple years back when the market was very poor, this was something that came up quite a bit. Poor market conditions can cause fair market value of an endowment fund to be less than the original gift, or the balance to be maintained in perpetuity. So, for example, if you had a $200,000 original gift in an endowment, and the market conditions took it so at year end the fair market value was $150,000, that would be an underwater endowment. It's important to note the organization is still allowed to take distributions out of an underwater endowment as long as it's in line with their spending policy. So that goes back to making sure you have a good policy in place. And then underwater endowments do create additional financial statement disclosure. So a couple of things we would have to add into the notes would be the dollar amount of the underwater endowments. And it's also important to note this is per fund. So let's say you have two separate endowments. You can't say, oh, one's doing really well and one's underwater, so we don't have to disclose that amount. You don't net those together. You just, each fund's considered separate. So you'd show the total of whatever is underwater. And then also you have to disclose what the organization's plans are to eliminate the underwater amount. So it can be maybe investing a little bit less risky. Whatever the organization decides to put in place to get that value back up to the original gift amount needs to be disclosed. audit documentation. So I just thought it'd be a good idea to go over a couple things. Like Brad said, you know, we come in and want all this documentation when we're there. So we'll go over a couple of things with endowments that we'd want to see. Of course, a copy of any endowment agreement. We like to, you know, we always read through these and make sure that, you know, we're clear on what the terms are and that the organization is spending those funds in line with what the purpose of the endowment was. We also would like to see support for the funds received as a donation in the initial year. So this would be more to support that revenue and any donations made into the fund in future years. So for example, if there was some sort of donation letter committing, I'm going to donate this $100,000 for the endowment, we'd want to see that, especially in the year of donation. And if you have even a check copy, if it's received, that's great too. And then another thing we'll ask for is an investment statement for the year under audit for the fund. So if you have a December 31st, 2023 audit or year end, we'd want to see that investment statement for as of December 31st, 2023. Also support for any funds that are spent to verify they were spent for the correct purpose. So this would be, you know, releasing those funds. In my scholarship example, if you awarded scholarships, having, you know, even if it was a letter to the student awarding them that scholarship, something to show what it was spent on and that it was for the correct purpose. And then copies of those related policies that I talked about. So, you know, we keep those in our audit documentation. Another thing I wanted to mention was, as an organization, really taking a look at these policies on a periodic basis and revising them based on, you know, the mission and vision of the organization at the time is a really good idea. It doesn't have to be every year, but, you know, make it on a periodic basis that the organization's comfortable with, or if something changes, of course. Couple other disclosure requirements that you would see in your financial statements. So a general description of UPMIFA and its rules for endowments. And I didn't put this on my slide, but I wrote down there's 7 factors for expenditure that each organization should consider when they're going to be considering spending the funds of an endowment. I'm just going to go through them. So the first one is the duration and preservation of the fund. Purpose of organization and the donor restricted endowment. So making sure you're considering that purpose always. The general economic conditions, because this can change the market value at the time of the funds that are in there. Also just, you know, how much donations are coming into the organization. So other revenue sources. Possible effects of inflation or deflation. Number 5 is expected total return for income and appreciation. So, you know, based on what the market is doing, what does it look like is going to happen at that point in time? Number 6, other resources available for the organization. And number 7, the policies in place. So those are actually listed in our financial statement disclosures. Also, just in general, those general rules I talked about on the UPMIFA slide. Another thing that we will put in the disclosures is a little summary of your investment policy. So we talk about the return objectives and risk parameters that are in the policy. A general description of the organization's spending policy would be included. And then also there's some numerical required information, which I put an example on the next slide here. Sorry, it's a little bit small. Okay, so I'm just going to go column by column because I think it makes a little bit more sense. This top portion shows basically the balance as of December 31st, 2023. So if we go down that without donor restriction column here, there's a board designated endowment at year end of $2,130,000. If we kind of skip down to that second chart, you'll see in this example, and the without donor restriction, they didn't have anything set up at the beginning of the year, so beginning balance would be 0. They got that $2 million contribution, or I'm sorry, this is the without donor restriction, so the transfer of funds that they decided to make. And then they made distributions out of that endowment of $30,000. So that goes to that $2,130,000 at the top. It all ties in. So this is the activity throughout the year, which relates back to that year-end balance. In the with donor restriction column, so you'll see at the top, the original donor restricted gift and amounts required to be maintained in perpetuity is that $300,000. And then we have a line for accumulated investment gains of $7,800. And then going towards the bottom, again, in this example, I just said there was 0 at the beginning of the year to make it a little bit easier. The contribution was $300,000. And in the market this year, the endowment made $24,000. So that's that investment return line, net any investment expenses. Also, there was appropriations made. So the $16,200, that would be for any scholarships that were awarded. They actually awarded that amount. So you see the 24,000 investment return nets with that 16,200 in the top for that 7,800. And this ties to the top 307,800. So this kind of just shows you a little bit in your financial statement disclosures. If you have endowments, you'll see these in each financial statement. And then if I skip back to the middle here, the funds with deficiencies paragraph, this is that underwater endowment disclosure. So in this example, you'll see at the end, it says the organization did not have any such deficiency as of December 31st, 2023. We're assuming they don't, not assuming this one, they don't have underwater endowments. If they did have an underwater endowment to disclose, this is where we would put that dollar amount and the spending or the plan to get the funds back up to the original gift, as I mentioned before. I think that's really all I had on endowments.
Awesome. Thank you, Rachel. So we had just a couple other questions pop in the chat here. So first one, when a donor contributes to an endowment campaign, is there specific wording that should be used in their thank you letter, or is it the same wording as a typical monetary donation? I'm not aware of anything specific that needs to be reported in there. There are some more specific rules when it comes to in-kind donations, but a cash donation is a cash donation for when it comes to adding or sending the tax deductible letters and sending the thank you letters to clients. Then another one on, I'm not sure on the answer to this. So Brad, I'm not sure in your research if you came across this, but you mentioned litigation in Ohio, and I know most of you are in Wisconsin, but is there legal precedent for pledges as a legally binding promise in Minnesota?
I guess on that, I would say two things is basically nationwide. In every state, they would generally be considered legally binding, just based on some of those reasons that I mentioned before. And then the other thing I would say is that I guess we're not lawyers, so while they're generally considered legally binding, if you want like specific case law, you would have to consult an attorney for that.
Thanks, Brad. So I think I got through all of the questions. If anyone had wanted to talk through a question, you can feel free to unmute yourself and come on, and we can try and answer your question. We'll hang on the line here for a little bit for anything else that comes in, but otherwise that was all that we wanted to cover today. So I do appreciate everybody that attended, and again, thank you to our presenters today for their work in preparing for this webinar. We are looking to kind of continue this as an annual thing in the future. And if there are ever any topics that you'd like covered at any of our webinars, feel free to reach out to your Hawkins Ash representative, and we'd be happy to work those into our next webinar that we do.